Hey everyone, welcome to Retire with Style. I'm Alex and I'm here with Wade, and we've got a whole series of Q&As to answer today. Wade?
Yes, and that has been a continuing theme with the podcast, although these are going to be newly recorded episodes in terms of the chronological order of things. I did a webinar on July 15th about 4 ways to manage sequence of returns risk. And we had a lot of attendees. So we had a lot of questions that we didn't have time to get to in the webinars and thought we'd do Q&As related to that here at the podcast.
Yeah, no, that sounds great. And as everyone knows, as our listeners know, we have a membership site, retirementresearcher.com. And there we offer many of our members, but also folks that have signed up to receive our newsletters, webinars. And so that's something that I would always keep an eye on. We have some exclusive to our members, our paid members, but we also have many webinars that we provide to our listening audience that are signed up for Retirement Researcher. Right, Wade?
That's right. Yeah. And I think we're aiming to do another one of those in September. So I'm sure we don't have a date yet, but we'll let everyone know as we get closer to then.
Okay. And the most recent one we had, it was on sequence risk, right? The 4 ways to manage sequence of returns risk. And from there, we've got loads of questions. But beforehand, could you maybe just give a little summary of what was
Sure.
discussed?
Yeah, it's probably worth mentioning what the 4 ways to manage sequence of returns risk are, because with the Q&As that we have, we've kind of questions related to each of the 4 different ways. So it makes sense to start with what those are. And even more clearly, what sequence of returns risk is. It is the idea that, especially when you're retired, it does exist pre-retirement as you're adding new cash flows and savings. But when you're retired, if there's a market downturn and you're forced to sell from your portfolio, you have to sell at a loss. You have to sell more shares. You have to sell a bigger percentage of what's left to meet a fixed expenditure. And then, even if the overall market recovers, the fact that you've been selling from a declining portfolio makes it harder for your portfolio to recover with the overall market. So retirees do become much more vulnerable to market returns in their early retirement period. That's sequence of returns risk. And the 4 ways to manage sequence of returns risk all relate to looking for ways to not have to sell at a loss effectively. So method number one, I call it spend conservatively. It's not the funnest approach, but it's the whole logic of something like the 4% rule is an example of the spend conservatively concept. It's if your spending's low enough, the percentage of the portfolio you have to sell to meet expenditures is lower. And then it becomes harder to get into a downward spiral where as the portfolio starts to decline, you have to sell a bigger percentage of what's left. Portfolio has a harder time to recover. You then have to sell a bigger percentage of what's left, and you get into a downward spiral towards zero. Well, if you just don't spend very much to begin with, that does help manage the risk of the sequence of returns. And so with that kind of discussion, it's always around, well, how low does a spending rate need to be to reduce the exposure to sequence of returns risk? But that kind of discussion builds in, it's just a research simplification, but it actually amplifies sequence risk because it doesn't build any sort of flexibility. It's just, I want to know how low the initial spending amount needs to be, but I'm never going to then adjust that amount, except for I'll take inflation increases, but I won't ever reduce spending if the market's down or anything like that. I'll just keep spending and spending. That creates more sequence risk, and it just becomes a question of how low does spending need to go. Now, we also talked about examples of each of these techniques in the webinar, and the one I used for this one, it's spending from your investments. So I talked about how delaying Social Security could help you reduce the lifetime distribution rate from your investments, even after carving out a Social Security delay bridge, like for instance, an 8-year bond ladder if you're 62, to help get you to age 70 without increasing your sequence risk because you had to use a higher withdrawal rate until your Social Security benefits begin. Method number two, be flexible with your spending. And that's the whole world of variable spending strategies. If markets are doing well, I might increase my spending. If markets are doing poorly, I might decrease my spending. And for that, I use the example of we have at the Retirement Researcher Academy, as Alex mentioned with Retirement Researcher, We have a membership website, and we do have a payroll calculator there that allows you to analyze variable spending strategies. So I provided a brief introduction to that in the webinar because it was coincidentally, we hadn't planned it at the time, but the day after that webinar, I did a workshop for our Academy members on how to use our new and improved payroll calculator, and looked at 8 different variable spending strategies and how you could compare and contrast and analyze and look for an approach that you feel comfortable making adjustments to your spending over time in retirement. The third approach is reduce volatility, because I should have mentioned with that spend conservatively, that's usually tied to an aggressive asset allocation. You invest aggressively. When Bill Bengen created the 4% rule, he said hold 50 to 75% stocks in retirement, but yet you never adjust your spending in response to that market volatility. So the third technique relates to, well, let's manage volatility of the investments in some sort of strategic manner. Now, there's a lot of possibilities there, whether it's a bucketing time segmentation strategy, whether it's using annuities. The example I did use for that was the idea of the rising equity glide path, where you have a lower stock allocation at the start of retirement, but you gradually increase it over time as a way to reduce your vulnerability to volatility in those early retirement years. And then the fourth approach is buffer assets, something outside your portfolio, not correlated with your portfolio, that can provide a temporary spending resource after market downturns so that you don't have to sell from your portfolio at a loss, and to try to create synergies around allowing your portfolio to recover by having that temporary spending resource from outside of the portfolio. Now, our next episode in the series of the Q&As will be all about buffer assets, because we got a lot of questions on them. But the 3 buffer assets, although some of the questions relate to, could we add a fourth? But the 3 I talk about are a cash reserve, just having a pile of cash on the sidelines, using a home equity conversion mortgage, the most popular kind of reverse mortgage, variable rate reverse mortgage with a growing line of credit, or borrowing from the cash value of permanent life insurance, particularly whole life insurance. So those are the 4 ways to manage sequence of returns risk. 4 broad categories: spend conservatively, flexible spending, control volatility, buffer assets. They do have a lot of subcategories, and we do have a lot of questions that came in from the webinar.
All right, Wade. Thank you for that synopsis there. Let's get to the first one then. And it's titled Nuance Question here. Can you address the potential for multiple sequence of return risks? I retired at 48. So I wasn't just concerned about the risk when I retired, but also at later ages since I plan to live to 100, thus having 52 years in retirement.
Mm-hmm. Yeah, great question to get us started. So thank you, Rich, for that question. And yeah, so to be clear about and I mentioned this in the summary, sequence risk is amplified if you don't adjust your spending in response to market performance. And so that's why those early retirement years become the most important. In terms of flexible spending strategies, if you just spend a constant percentage of what's left of your portfolio every year, there's actually no sequence risk for your investments. They're not vulnerable to being depleted. You could have a lot of risk with how much spending fluctuations you experience. But so getting into the context of, if you're retiring at 48, it's almost like you want to be thinking about a variable spending strategy. You can't, and we can talk all day. The 4% rule idea is based on a 30-year retirement horizon, thinking about people in their 60s. If you're retiring in your late 40s, as Rich mentions, you may have a 50-year retirement horizon ahead of you. It's really harder and harder to imagine having constant inflation-adjusted spending over time. A variable spending strategy would make more sense. But if you were strictly following a constant inflation-adjusted spending strategy, the time horizon doesn't really matter so much. If anything, and this is a point that will be part of an answer with some of the other questions that came in as well. The longer the time horizon, the smaller the withdrawal rate you should be using to sustain those assets over the longer time horizon. And actually, a lower withdrawal rate reduces sequence risk. But you're still going to be the most vulnerable in those early years. Now, if you make an adjustment, if you change your spending later in response to market performance, that can alleviate the sequence risk. And then you could, quote unquote, start over from that point looking forward. But just strictly speaking, if you're retiring at 48, and you're using the spend conservatively strategy, you've got to use an even more conservative spending rate. Your spending is going to be low. You're going to therefore have less sequence risk, but you're still going to be the most vulnerable to those market returns in those early years if you don't have any sort of other adjustment factor. Now, maybe another adjustment factor is the potential to return to work or to at least have part-time work at some point. You could almost think of that as a quasi buffer asset if you really think there's potential to return to work during a market downturn. Of course, it may be harder to find job openings and so forth at that time. But that's kind of how I would approach it. It's not that there's going to be multiple periods of sequence risk if you're using a spend conservative strategy, but it's really more, you probably don't want to be using a strict spend conservatively strategy over such a long retirement horizon.
All right, Wade. This is a next question from Lynn, and this has to do with, to me, it reminds me of the research you did on the magnitude of failure and the actual disproportionate impact that when you're just retired, could have on your spending. But here goes the question. I often hear that the sequence of returns risk is greatest in the first 5 years after retirement. I don't quite understand this. Suppose there were two people, A and B, with identical assets in identical locations. Their age is identical. Both are the same age, have the same life expectancy, withdraw identical amounts from identical assets at identical times. And this sounds like us, by the way, Wade. And in general, A and B are completely identical. The only difference between them is A retired 10 years ago and B has just retired. Why doesn't the sequence of returns impact both of them the same way during the 5 years after B's retirement? Why is risk greater for B than for A?
Yeah, it's a great question from Lynn. And actually, this question sparked a lot of discussion in the chat during the webinar as various folks were trying to answer it and kind of a lot of back and forth. Now, during the actual webinar, I wasn't able to review questions, so I could only see this after the fact. But there was a robust discussion about this question. And I think it's because it's kind of a bit confusing in terms of creating a hypothetical scenario that isn't necessarily possible, or at least there's got to be something different. Strictly speaking, the way the question's asked, person A retired 10 years ago, person B retired today. Now, due to the dynamics of the markets and everything else, they're exactly in the same position today in terms of
I
they
will
both
say
want to.
10 years more of salary that that person B got.
Well, yeah, so the past 10 years happened.
Yeah.
Person A has been spending from their portfolio for the last 10 years. Person B's been earning a salary for the past 10 years. So the kind of the magical leap here is after all that, today they're both in exactly the same position.
Okay, right.
So today, looking forward from today, they both need the same withdrawal rate to meet their expenses. They're both the same age. They both have the same time horizon. If all that's true, and that's what the question's saying, like if all these things are true, then yes, they have identical sequence risk, because you can always kind of reset and say looking forward to from today. And if they have the same withdrawal rate today, they have the same sequence risk. But that's kind of an odd hypothetical to be talking about, because it means they would have had very different situations 10 years prior to retiring. Person A has been spending from the past 10 years. Person B has been working for the past 10 years. Person A was vulnerable to the market returns from the previous 10 years in a way that person B was not vulnerable since they weren't retired yet. If markets did fine over the past 10 years, like if we think of it more, if we try to make these people comparable, it's like they had the same amount of wealth when they retired. And then we could talk about the comparability. The way Lynn asked the question,
Yeah,
A now has the same amount of wealth as B 10 years after A retired.
let me ask you that, as opposed to becoming a logician and trying to figure out A equals B and B equals C and A equals C and all that kind of stuff. At the end of the day, Wade, I think what you're trying to convey, and please correct me if I'm wrong here, with regards to sequence of returns risk, and this is getting down to the fragile decade. Why is that fragile and not previous, not more previous to that or more after that? It's simply because, as you're winding down, your human capital is shrinking. And so investments, you're in accumulation mode, so you can weather downward swings because you're working, you're drawing from your human capital. When you retire, the portfolio now has that extra burden effectively, and you've got to get over this hump. You got to give yourself this quote unquote, let's say, margin of safety of good number of market returns that are positive, and that takes years to put in. So while you're 5 years from retirement, 5 years after retirement, your human capital is depleted, hence you're going to have to rely on your portfolio, and it's very important to get off to a good start. And getting off to a good start is purely based on just chance outcomes of what economic cycle you retired in. All right. And so that's what you're trying to get over. And that's why you need to get a couple of years in to get past that. And that, I think, is the gist of what you're writing about and saying, as opposed to, playing these kind of, let's see if we can break down the logic here games.
Yeah, and the person who retired 10 years ago had that chance to get
Yeah.
off to a good start or a bad start already. If the markets did fine over the past 10 years and they had a conservative spending strategy, their portfolio would have probably continued to grow. And so it would have been higher than, well,
Yeah.
not higher than B's. We got to figure out where things matched up. But the
Yeah, but
point is,
don't worry about breaking down the logic of this question, because I think it's good. You're gonna inadvertently confuse the more important point of what
yeah,
I
yeah.
think people should be taking away.
I guess the simple way to answer it is, yes, Lynn, if A was in exactly the same spot as B 10 years after A retired, they now have the same sequence risk looking forward. It's just really hard to get into that spot to begin with.
Yeah, here you go.
It's the easiest way to answer it.
Okay. Because I think the gist is what we just conveyed. Like, listen, it's about getting off to that good start, and you need to give yourself that margin of safety.
Yeah, it's kind of like if they had the same amount of wealth 10 years ago, they'd be in very different spots today.
Yeah. Okay. So let's get another one in here. Lynn comes back from Mar.
Yeah, this was part of the ongoing discussion, but I thought this was it was a
Right,
different
no, fair
question.
enough. So perhaps another scenario might explain the confusion. Person A retires at age 40 and is now 45. Person B just retired and is now 50. They have the same life expectancy. Wouldn't A have a greater sequence of returns risk than B, all else being equal, because A's assets will need to last longer?
Mm-hmm. So, and by them having the same life expectancy, since A is younger, 10 years younger, or no, what? Well, anyway, A was 10 years younger than B. So A needs their money to last longer because they're both, say, going to live to age 90. A has a longer retirement horizon than B. So this gets back to what I was saying, how I was making a point that comes up for later questions. The younger you are, the longer your remaining time horizon, the lower the withdrawal rate you have to use. But then, so technically speaking, A may have less sequence risk than B if A is using a lower withdrawal rate. But I get Lynn's point about, yeah. I mean, A definitely has more risk. It's not necessarily the sequence risk exactly, but their money needs to last for 10 years longer than person B. So that does create more risk and more vulnerability for them. It may not be sequence risk, because if A is using a lower withdrawal rate, they might actually be less exposed to sequence risk. If they were using the same withdrawal rate, then A has, it's not going to be sequence risk, but A has a longer time horizon, so they're going to be more vulnerable to depleting their investments.
It's longevity risk at that point.
Longevity risk, yeah.
All right. So, yeah, it is a good question in the sense that she pointed out, yeah, there's many risks in retirement. One of them is the sequence risk, longevity risk, and probably peppered in between that is liquidity risk. All right. Okay. We'll get one more question here from John B. Johnny B. Good, I assume. John B. If one has a sizable pension that covers all daily needs, how much portfolio risk with balancing would be acceptable? And so currently, with 35% bonds, short and intermediate, 30% large caps, 15% small caps, 15% international, 5% cash. Since '08, the overall return has been slightly above 8% using mostly index funds. Could or should I change strategy?
Okay, and John's question actually came in through an email to Retirement Researcher. It wasn't a webinar question, but I was trying to figure out where's a good place to put it. This episode is really about nuances of sequence of returns risk, and I thought this question brings up a good nuance of sequence of returns risk. And it's how the question begins. If one has a sizable pension that covers all daily needs, how much portfolio risk with rebalancing would be acceptable? That individual doesn't have sequence risk. They have reliable income covering all their expenses. They don't really need portfolio distributions. So that gives them risk capacity. And it's like, it almost becomes, they've got a lot more flexibility about how much portfolio risk
Risk
is
is completely a,
acceptable.
a preference for them.
Yeah, they don't need any risk because they've got their lifestyle covered already. They that means either they take no risk or they completely maximize their risk just because it's all discretionary wealth. If they have legacy goals at some level, they're really just investing that for the legacy purposes. Maybe whoever their beneficiaries are could take more risk.
Also,
They've got risk capacity.
daily needs could mean essential, and they still want to live life and enjoy life. Beyond essential, they want discretionary. So this is meant to fund their discretionary.
Well, if it's funding the discretionary,
That's
the
how I read.
academically optimal way to spend in retirement is you do cover your essentials with reliable income sources. So it's kind of the income protection approach from the RISA. And then you can use a variable spending strategy from the investments to meet more discretionary types of expenses. Now, the more aggressively you invest for the discretionary expenses, the more volatility there may be for those discretionary expenses. But on average, you might expect to be able to spend more over time that way on discretionary goals or on legacy or just on having additional reserves. So it's at that point, really, it becomes open to there's nothing we can say about should you change your asset allocation. It's more about what are you comfortable with,
I
recognizing
agree.
you have the capacity to be flexible with the approach you take.
Now, if they're asking within this, the 35% is the 35% bonds too much, too little versus large caps, small caps, etc. This is all. There's a whole host of other questions here that you would naturally ask. Just what types of bonds, what types of large caps, small caps, international, etc. To
Yeah.
go into it. But
And
that's
with their asset allocation,
another
they're
vibe.
60-40. Overall stocks, 60%, bonds, 40%,
Yeah.
just to simplify all the different asset classes that you listed off. So we can't say you should change it. We can't. I mean, it sounds
It depends. I
reasonable,
mean,
but
this is one of these. It depends. It depends on your style, but also I don't know what's in it. We could say yes, change it, but within the large caps, do you have value? Yeah, those kind of questions. Is there room for REITs? Uh, international. Yeah, are the bonds pegged to the dollar or not? Yeah, so there's sub questions to ask before getting into this. But in light of the theme of sequence of returns and the like, I think the bottom line here is that he or she is covering enough for their daily bread, which is what's important, and we're going to assume the rest of the investments are for discretionary. And at that point, as Wade is saying, risk is completely a preference for how much they want to achieve. If they only want to go to Disney World once a year until that's it, well, I'm guessing they probably have enough, with a moderately diversified portfolio. But again, that gets into what's discretionary and how impactful they want to be with their assets in this life and in the next.
yeah, it's just the idea. The more aggressively they invest, the more variability there will be in the growth of that portfolio over time. But on average, you would expect, at least on average, a higher balance, greater growth over time.
All right, wait. Those are the Q and A's for sequence of returns risk.
Yeah,
How
for
you
the
feeling about that?
yeah, that's that. So we've got more on the sequence of returns risk. This is kind of a short episode, but I guess that works. We'll
Yeah,
give
yeah,
our
that's
listeners
fine.
a break,
We,
and
we, we always say we want to get them into about 20 to 30 minutes, and we always
well, there
do
you go.
30 to 40. So I'm going to take this as a victory. Unless you
Yeah,
want to tell everyone about your Japan trip for the summer.
yeah, that's now in the past tense with this recording.
All right.
It's all good. gonna put
Uh,
small talk at the end of the episode.
yes, yes, extended cut. But no, that's it, everyone. Thank you for listening, and we'll come back next week with a little
With
bit more
buffer,
on
yeah, buffer
sequence risk,
assets.
buffer
Hmm.
assets specifically. All right, everyone. Bye.
Okay.